This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
One of the most likely disposals that you're likely to see in an examination question, so far as companies are concerned, is when the company makes a disposal of shares. Shares, obviously, that it has acquired in another company, and probably shares that have been acquired in that other company over a period of time. The problem, as you will have been, I hope, revising from last time to this, is that when we sell shares, which shares are we selling? Now, as we'll see here in Note 3 in Chapter 19, there are specific share matching rules for companies. Now, in some ways, it starts off as being similar to what the share matching rules were for individuals, but then, of course, there are some important differences that we need to know. Right. So when a company sells off some but not all of its shares in another company, which are the shares deemed to have been sold first? So, thus, the shares sold are deemed disposed of in the following order. Now, just as with individuals, firstly, shares acquired on the same day. If you buy and sell and buy in the same day, you match those shares acquired with the shares now sold. Again, probably in an exam question, not that likely. But in terms of if there is going to be a very specific recognition of a disposal or part of a disposal with a very specific acquisition, it's the next one. Shares acquired in the previous 9 days. You'll remember, no doubt, that when it was an individual making the sale, that after having related the sale, if applicable, to shares acquired on the same day, we then looked again very specifically at shares acquired in the following 30 days. Not so here. Now, more sensibly you might think, we look back in time, but we simply look back over the previous 9 days. If there are any, then that is a specific reference that we make. Now there, of course, you're going to have to sort out of the total number of shares sold, how many relate to that individual acquisition the previous 9 days. Work out how much of the proceeds belongs to that sale, and then relate it to that cost, and calculate, again, your gain or loss. Now that calculation is not going to require indexation allowance. It will simply be a straightforward comparison of proceeds, less selling expenses if there are any, but proceeds with cost. Where most, if indeed not all, of the work that you're going to have to do in an exam question is going to be involved is in this third one. It's the share pool. Shares contained within the share pool, which is made up of any shares acquired more than 9 days previous. Now, as I say, it's possible that when you see a disposal, some of that disposal may be related to an individual acquisition that did happen to fall within the previous 9 days. But almost certainly, the majority, if not the entirety of the disposal, will have to be matched with the share pool. Now again, I hope you recall how it was for an individual that we dealt with the share pool. That the share pool recorded the number of shares acquired and then sold, and the cost of shares acquired, as we said, for each acquisition and then each resultant disposal. Now we've got to record that self-same information as we did for individuals, but there's a new factor that comes into the calculation of the gain, and that is companies, as we learned last time, get indexation. Companies are entitled to indexation allowance. So it is not simply the comparison of proceeds with cost that gives us a gain. It's proceeds less cost less indexation allowance. So, whenever shares are purchased or sold, this is from within the share pool, a re-indexation of the index cost of the shares in that pool is added to, and here's your new column, an index cost total. What this means is that we've got to add now just a simple third column to the share pool working that we did. We will still record the number of shares bought and sold. We will still record the cost of those shares that we have purchased and the amount of the cost that goes out of the pool with any disposal. But along with each such acquisition or disposal, we're also going to record an index cost column. Now notice index cost, not an indexation allowance column, but an index cost column. So what does that mean? It means that into that index cost column, when we buy shares, we will record the cost in both the cost column and also in the index cost column. So what goes to the cost column also goes to the index cost column. But whenever then, having bought shares and put that cost also into the index cost column, whenever we've bought shares or we sell shares, we must re-index that index cost from the last time we re-indexed, or if there was just one purchase, from the date of purchase, all the way through to the date of sale. That index cost column is going to keep for us a running total on the shares held within the pool of what their cost plus indexation allowance total is, the index cost column. Now, it's not a difficult exercise, it's a very mechanical exercise, and you just spend more time punching your calculator here than anything else. Not difficult, very mechanical, we just have to learn the technique. But the only new aspect to this, from the very simple share pool that we put together for the individual, is that to the number of shares column, the cost of shares column, we add a third column entitled index cost. What goes into it? Any cost incurred when we buy shares, plus whenever there is a subsequent purchase and we buy more shares, or indeed eventually when shares are sold, we have to, as it's called, re-index the total on that index cost column, simply bringing it up to date for the effects of inflation to the RPI now from the RPI at which we had last re-indexed that pool. So that's going to be our problem. Right, let's have a little look therefore at example 2 to see how it is that we deal with such a disposal. Our requirements: calculate, of course, the gain to include within the corporate tax computation for the year ended 31st of March 16. Again, we must relate the disposals made to the accounting period, the chargeable accounting period for the company in which they will be charged to tax. So we'll need to know what accounting period we'll be dealing with. You can see here, just at the bottom of this information in the question, the company has a 31st of March year end. So year ended 31st of March, we knew from the question what transactions occurred therein. Now we can see that here A Limited sold 3,000 shares in October. To be very precise, and here in fact we are going to need to be very precise, on the 10th of October 15, at a time when the RPI was 259.5, we sold those 3,000 shares for £36,000. We need to therefore identify which shares are the ones being sold. Remember our order of identification: shares bought on the same day. So we'll check to see whether any were also bought on the 10th of October 15. Otherwise, were there any acquired within the previous 9 days? So previous 9 days, that will take us back to what, the 1st of October there. If there are any such acquisitions in that period, then they will be individually identified. But then, as we said, most if not all of the work will be about putting together that share pool, in which we'll record from the earliest acquisition, falling outside of the previous 9 days, what were the number of shares bought, what was the cost of those shares, and put that same cost into our index cost column. We will then update those columns for every new purchase and or disposal of shares that subsequently occurs. So what are the purchases of those shares in B Limited? We are told we've got, firstly, here, remember we're dealing with A Limited as regards the disposal, and A Limited bought the following shares in B Limited. Go all the way back to August 89, when we bought 1,000 shares at a cost of £5,000. Very clearly that is not the same day nor the previous 9 days, so those shares will go into the share pool. We've then got November 96. Again, those shares will go into the share pool. But then look at this very specific date, the 7th of October 2015. What was our disposal date? The 10th of October. So it's not the same day, so there's no acquisitions on the same day with which to relate this disposal, but there are shares that had been acquired within the previous 9 days there. And on that basis, we will need to deal with them. Okay, now looking again at the information, just to ensure that we know what to do here, we've got to work out the gain arising on the sale of the 3,000 shares on the 10th of October 2015. We have identified from the list of acquisitions provided to us that the two original acquisitions back in August 89 and November 96 will go into a share pool. But prior to dealing with any sale of these shares out of that share pool, we must firstly deal with the acquisition that occurred within the previous 9 days, there having been no such acquisition on the same day, which is our first port of call. Right, how many shares were acquired, therefore, within the previous 9 days? 500 shares. So we now know that of the 3,000 shares that are being sold on the 10th of October, 500 of those represent the ones bought on the 7th of October. Those will be identified first, followed by what must then be the remaining 2,500 shares. We've got a sale of 3,000, of which the first 500 are the 7th of October 15 acquisition. The remaining 2,500 shares, therefore, must come from the share pool. So we will at that point need to put together the share pool calculation. Now, depending on exactly when you are doing this, you may or may not see in relation to the question in your copy of the notes that there is recorded here for October 15 an RPI of 257.7. That is incorrect. That's an updating error. That should not be there. So if your version shows that, then do as I'm doing now, just delete it. And again, my apologies for that not being picked up on the review process. We know that the RPI in October is 259.5, and that is the figure that we will be using in answer to this particular examination question. Or examination style question, shall I say. Again, irrespective of whatever the RPI was in terms of the previous 9 days, it's probably going to be the same month anyway, but there will be no indexation allowance in relation to that particular disposal. So on that basis here, all we've got to do, work out what part of our sales proceeds represent the shares bought on the 7th of October. That's 500 shares out of 3,000 shares. Get the proceeds and deduct from that the cost of £5,000. That will be a chargeable gain. And that will be it. That will be the chargeable gain. There is no indexation. But just, if you have not already, delete the incorrect RPI given there for the 7th of October 15. If, of course, you're looking at this on a later version, an updated version of these notes, then there may not even be an RPI next to the 7th of October 15. Hopefully that will be the case. Or indeed check on your errata sheet to see whether that is actually included there. But for us, therefore, simple exercise to begin with, we now know that of the 3,000 shares sold on the 10th of October, the first 500 come from the 7th of October 15 acquisition. So what do? First part of this disposal, those acquired within the previous 9 days. We will then show our calculation of the gain. The sales proceeds. This is the only working that you've got to do. We are selling 500 shares out of the total of 3,000 shares sold on this day, the 10th of October 15. 500 over 3,000 there. Oops, shouldn't have put an end to the brackets. 500 over 3,000 times what did we sell them all for? £36,000. Now again, if you'd wanted to, you could have simply divided £36,000, the total proceeds, by 3,000 shares, the total shares sold, and got a sales price per share and applied that to the 500 shares. It's just that it might not be a round number. This one would be fairly easy, but it might not in other circumstances be a nice round number. So this way you'll always get it right. So how many shares sold? 500. Out of a total sale of 3,000 times £36,000 of proceeds, and that therefore should tell you that in relation to the shares acquired, I repeat, within the previous 9 days, they being the ones bought on the 7th of October 15, we got proceeds of 6,000. What was the cost figure? Look back to the information in the question. Cost £5,000. Cost therefore £5,000. Take it away. And we are talking still about a gain of £1,000 having arisen there. So, applying the rules of identification, nothing acquired on the same day, one acquisition within the previous 9 days, as much as there will ever be, straight comparison of the amount of the proceeds of this sale attributable to those shares, here 500, less specifically their allowable cost, and that's it then. If the cost as here is less than the proceeds, it is a gain or otherwise an allowable loss. And having identified that sale out of the 3,000 shares sold, it will mean that the remaining 2,500 shares that we have sold must have come from the share pool. And that therefore means that it is now the share pool working that we will need to put together. So, let's move on therefore and construct that share pool. Now then, our share pool. Remember what the purpose of the share pool is. It is to give us the allowable cost, and now also in corporate tax, to give us the allowable indexation allowance that will allow us to deduct cost and indexation allowance from our proceeds on a sale of shares and therefore calculate the gain. So we do not calculate the gain within this working, you can see I've identified this as working 1 here, the share pool. We do not calculate the gain within the share pool. The gains calculation will be a separate calculation, showing, as we always do for corporate tax, proceeds less cost less indexation allowance, bringing us down to the chargeable gain figure. But where do we get the cost from? Where do we get the indexation allowance from? It is here within the share pool. So how do we construct it? We go back to, as from the question, we've identified the earliest and first acquisition of shares within this company. Now that was based on the 20th of August 89. 20th August 89, an acquisition, a purchase of shares. So looking at the information within the question, on the 20th of August 89, how many shares do we buy? 1,000 shares. Into the number of shares column it goes. At, what was the cost? £5,000. Follow that again in your question. Cost 5,000. And there what you've done is as you would have done it for an individual. Recorded at the date of purchase, how many shares and what was the cost. But now we're dealing with corporate tax, we run this third column, the index cost column. And whenever we have a cost included, we add that cost also into the index cost column. Simple enough, it's not difficult, we've just added that self-same figure of £5,000 cost into not just the cost column, but this separate index cost column, the purpose of which we will see in a moment's time. Okay, what then happened? Well, all was quiet until the 16th of November of 96, at which point we bought another 2,000 shares. Now it is at this point that we see a difference in the construction of the share pool, because whenever we buy more shares, or eventually when we sell some shares from this share pool, there is a need for us to re-index our index cost column, bringing it up to date for movement in the RPI from here, the original first acquisition, or subsequently from whatever was the last time we had re-indexed our index cost column. Now it is re-indexation as we call it. So we will now show, and we do this before dealing with the addition of the shares acquired. First thing to do, re-index the index cost column. Now, what is in the index cost column? You can see there a cost of £5,000. So it's that figure that we now re-index. And the basis of the indexation to begin with is exactly as we saw before. What is the RPI now? Not now, in fact, at the month of disposal, which previously it was in our first session, but at the next date of an acquisition, a purchase or disposal. If you want a technical expression on that, these purchases, these disposals are known as operative events. But all we need to know is when we buy shares or when we sell shares, before dealing with the purchase or disposal, we must firstly re-index the value in our index cost column. That is 5,000 multiplied by. Right, what is the RPI now at November 96 when this second addition occurs? So we are told November 96 RPI 153.9. What was the RPI when we originally bought those shares, the only shares in this pool, the acquisition in August 89? That was 115.8. All over 115.8. Now here, a little bit of good news. Normally, when you calculate indexation allowance, you establish a 3 decimal place indexation factor, so you round to the nearest third decimal place and you multiply that out by your cost. Here on re-indexing, you don't bother with the rounding. It's the only time we do not round to an indexation factor. And all we do is just leave that in our calculator, 153.9 minus 115.8 all over 115.8. As I said, there's little in the way of theory here. It is all about mechanics. It's a very mechanical exercise. So put that calculation using those RPIs through your calculator, leave the result, don't round it, just leave it in your calculator and multiply out by the £5,000 figure of index cost. That is the figure that we are re-indexing. And the result of that is added to your index cost column. Now, when I put that through my calculator, what I've got, hopefully correctly, is £1,645. Add that in, which means at this date, bringing the index cost column up to date for the effects of inflation from that original purchase through to the date of this second purchase, our index cost column will now read £6,645. £6,645. At this point, now the date as we know, the 16th of November 96, we now add in the effect of that acquisition. How many shares were purchased? 2,000 shares. What did they cost? According to our question, £12,000. Remember, whatever cost goes in the cost column also is added to your index cost column, 12,000. And at that point, we need to get a revised subtotal that will now tell us that in November 96, at that point following the acquisition, we had 3,000 shares in the share pool that in total had cost us £17,000 and at that date had an index cost of 12,000 plus 6,645, £18,645. So we have re-indexed the index cost figure from the last re-indexation, or for us here the original acquisition date, through to the date of this so-called operative event, being either a purchase of shares, which this is, or indeed when we get to it next, the disposal of shares from this share pool. So there we go, November 96, the share pool is up to date. There are 3,000 shares within it, having cost £17,000, with an index cost at that date of £18,645. Through to the next operative event. When was that? That was the date of disposal. Now what we do prior to dealing with the disposal, which will be the purpose of this exercise, to know on the disposal what cost goes with the shares sold, what index cost goes with the shares sold. But what we must do, either on a purchase or a sale, is to re-index. So we're now going to re-index through to October 15. What figure do we re-index? That last total on our index cost column. What is that? Our re-indexation here will be based on £18,645 multiplied by. Now you know what was the RPI the last time you did a re-indexing. You've got it there. You indexed up to November 96 using the then RPI of 153.9. That was the last time we re-indexed, so we are indexing from an RPI of 153.9, and this calculation will be all over 153.9. So the only new figure to come in that we haven't yet seen on this working is the latest RPI, the one for October 15. What was the RPI in October 15? Now that we've eliminated that incorrect figure, if there was one for you, of 7th of October 15, on the date of disposal, 10th of October, the RPI for October 15 is 259.5. So in it goes, 259.5. Now remember, put those RPIs through the calculator, 259.5 minus 153.9 over 153.9, and leave that in your calculator. Then apply that number to the index cost column of 18,645. Put that through your calculator, and hopefully, if we both used our calculators correctly, that comes to £12,793. We now add that into the index cost column. Our number of shares and cost of shares has not changed as yet, until in a moment's time we now deal with the disposal. But at the point of disposal, add the two numbers up in the index cost column, and the index cost value at the date of disposal is 31,000, and I made that there, well, I'll make it 31,438. 31,438. Now, having done your basic mechanics of re-indexing the index cost column, now we can deal with the disposal. So we've got the date, the 10th of October 2015. We are dealing with a disposal, and how many shares are being disposed of. Now, we've already dealt with it, but go back to the workings we've done. We saw that in the question 3,000 shares were sold, and we have already computed the gain on 500 of those shares. So coming from this share pool, there are 2,500 shares. It's a pool. Therefore, we now need to take out on a pool and average basis what will be the amount of cost attributable to those 2,500 shares, and what will be the amount of index cost attributable to those self-same 2,500 shares here. So we are getting rid of 2,500 out of the 3,000 shares in the pool. The 3,000 we sell 2,500. And we will multiply out that firstly by the cost figure of 17,000, and that figure will go in there. We'll then do the same calculation, 2.5 over 3,000, times our index cost figure of 31,438, and that figure will go in there. Okay, so get your calculators out, start working that through for me, please, and we'll then have the information that we'll then be able to use within the gains calculation itself. So could you do that for me now, please? Okay, well, if you've done the calculations, well, if I've done the calculations as well correctly, what we hopefully got when we established the amount of the £17,000 cost that was attributable to this disposal, that figure, methinks, should have come out to £14,167. Applying the same fraction, 2,500 over 3,000 times the index cost value at this date, should have given us 26,198. What we could then do is to update the balances on this share pool. We know 2,500 out of 3,000, there would be 500 shares, and then get your respective figures of allowable cost and index cost. When you refer to the model answer, you'll see those numbers. But just deducting the 14,167 from the 17,000 and the 26,198 from the 31,438. Those will be then the cost and index cost figures of those 500 shares remaining. So should they be sold in the future, you'll know what their cost was, and with re-indexation to that future date of disposal, you'll know what their index cost would be. Okay, but having got those numbers, now how do we show that in our gains calculation? We've got all the numbers we need to do our separate gains calculation. So, sales proceeds to begin with. Sales proceeds. Remember, this is 2,500 shares coming from the share pool out of not the number of shares in the pool, but how many shares were sold. That was also 3,000 shares. We sold 3,000 shares for £36,000. We have already disposed of and dealt with the disposal of 500 of those shares, therefore remaining 2,500 shares, 2.5 over 3,000 in relation to the shares sold times £36,000 worth of proceeds. What does that work to as a figure of proceeds? Well, that, of course, the other bit left over out of 36, it's £30,000. Less cost. Back to working one for that cost. What was the cost figure? There it is, 14,167. Note we do not shortcut this exercise by merely deducting the index cost figure. Remember, what does that represent? It is that same cost, 14,167, plus the indexation allowance effectively attributable to that figure. That was the 26,198 there. We deduct the cost. So again, we get an unindexed gain figure. So 30,000 less 14,167 will give us £15,833. Now you might think, why not just shortcut and go less index cost? The reason being, when we deduct cost, we know that we come down to an unindexed gain figure. That is the unindexed gain. But we know that when we then go on to deduct, as we will here, indexation allowance, our IA, our indexation allowance, that we cannot create nor increase a loss. So by deducting cost, if the cost here had been more than £30,000, say £35,000, that would show a loss of 5,000. And there is then no further indexation to add to that loss. You cannot increase a loss by the use of indexation. Or if we discover that this unindexed gain had been lower than the amount of indexation allowance, then the deduction of this indexation allowance, we'll show it in a moment, could only bring down that unindexed gain to nil. Now, even though you knew that there was not going to be a problem, there will be a chargeable gain remaining, because having sold for 30, the index cost you can see there is 26,198. Don't shortcut. Show the examiner the correct technique. The only time you could shortcut here is if this is an objective testing question where there is no need to separate out, there is no need to demonstrate the process. All the examiner is interested in is what is the correct answer. However, the amount of work here is rather more than an objective testing question. But if it was a rather briefer version, we only simply need to know the figure of gain. But for us, indexation allowance now to deduct. How do we get that? Well, the working that we show. We know that the indexation allowance is the difference between the cost of the shares now sold and the index cost of the shares now sold. Both of those figures have the cost figure within it. The difference is the indexation. So all you do looking at the information up here from the disposal that you've taken, 26,198 was the index cost of the shares sold, 14,167 was the cost of the shares sold. So the difference between those two figures is now your indexation allowance to deduct in deriving the gain. So 26,198 minus 14,167, all being well, comes to £12,031, less of course than the unindexed gain, so it will leave us with a chargeable gain which we can label, and that chargeable gain should amount then to, I made that £3,802 as the chargeable gain on this part of the overall share disposal. We've got the sale of these 2,500 shares from the share pool. Well, if you now look at the answer to the example there in the back of the course notes, here I think it's on page 195. I'll just check for that. I think we're on page 195. Yep, there we go, page 195. If you check through, you'll see the initial calculation of the gain on the shares sold from the acquisition within the previous 9 days. That was the 500 shares. You got the chargeable gain of 1,000. We've then shown through the workings of the share pool to establish the cost and with it the indexation allowance that attaches to the 2,500 shares now sold from that share pool. That's then gone into the gains calculation we've just seen, resulting in a chargeable gain of 3,802 on those 2,500 shares. What we've got to do, of course, is to know what gain goes into our corporate tax computation for the relevant accounting period. So out of this one disposal of 3,000 shares, there is in total £4,802 worth of gains, as we have just seen. 4,802 being the 3,802 plus the £1,000. As we said, both of which gains calculations we have previously seen. That's the figure then, 4,802, to put into your corporate tax computation. Now, just before we leave this particular session, I'd like you to just look at this note here. When we put together the share pool, what we had to do was to show the correct calculation of the so-called re-indexation of the index cost column. So what it was therefore is, when in November 96 we had the second acquisition following on from August 89, we re-indexed up that index cost column from the 5,000 that it originally was, and what we did not do when we put those RPIs through the calculator was to round. We didn't apply an indexation factor, we just left the result in the calculator and multiplied it through by £5,000. When then we re-indexed through to October 2015 from November 96, again picked up the relevant RPIs, left them in the calculator and multiplied through by what was the balance then on the index cost column, 18,645. Absolutely. We note that when re-indexing the index cost here in the share pool, we don't round an indexation factor to 3 decimal places. But what might happen in an exam question put there by the examiner to help you, not to make life more difficult, but to actually help you, is that rather than just giving you the RPIs and you do these workings here, that are not difficult, they just take time, what he might do is to give you indexation factors from one relevant date through to another for ease of calculation. So rather than telling you here the RPIs as we've done there, he might give you an indexation factor to November 96 from August 89 and give you a further indexation factor from November 96 through to October of 2015. Now that may or may not be taken to 3 decimal places. If it is, fine. It's not technically quite right, but you use it. So if they give you an indexation factor, don't be put off by the fact that it might be more than 3 decimal places, because we know we do not round, but whatever figure the examiner gives you, use it in these calculations here. Use it in your re-indexation calculations. He's doing it to make life easier for you, not to make life more difficult. And especially now, as we may see an objective testing question in section A for 2 marks where you've got to calculate the gain, and what you might have is a disposal coming out of entirely a share pool. Maybe you were dealing with a sale here of 2,500 shares that all came from that share pool. So you had to put this working of the share pool together to get effectively that figure of index cost, which we know we wouldn't show it as such on our calculation, but to get that index cost then to deduct from your sales proceeds of £30,000. That an objective testing question is then made easier by the fact that you don't have to do these detailed RPI based reindexation calculations. Pick the indexation factor up as provided and multiply it through by your index cost figures. He's trying to make it therefore not a 4-mark exercise in terms of the time taken, but a 2-mark exercise. You may even see this information provided in a written question, in which case don't say, well, that's not right, you shouldn't be doing it that way. Take what is given. They probably won't give you the RPIs anyway, they're going to give you the indexation factor instead. Use it. Make life easier for yourself. It means you can do it more quickly. Now in our next session together, still within the same chapter 19, you'll see that type of information provided, most notably in terms of past examination history. We're dealing with a takeover. To make a gain, the mechanical computation is just a little bit more straightforward. They give you, therefore, indexation factors to use. There is an old British or English proverb, if you prefer, never look a gift horse in the mouth, whatever that means, but it means, basically, bottom line, don't make life difficult for yourself, take it. If they give you something that makes the problem easier to resolve, just use it. So I'll pick that out for you and deal with it in our next session together when we finish off, indeed, all being well in that next session, when we finish off chapter 19.